Testing, 1, 2, 3. Take a sip of my coffee. It's that hot. You're not supposed to drink coffee when you're on the record because it's not, especially with cream, it's not really ideal for your vocal cords. Just so other people know to do as I say, not as I do. In any case, welcome to episode 13, lucky number 13 of Hacker Practice. My name is Justus, and I will be your host today. Our guest is a good friend of mine, an angel investor and a real estate investor in the Boston area. His name is Matt Javitch. Matt has been a close friend of mine for the last couple of years. I'm really excited for this conversation because we really dive deep into what it takes to quit your job and make a living exclusively off your investments. And I'm going to try to keep this introduction short and just cut to the chase. This is a great conversation on real estate investing and life and networking with my good friend, Matt Javitch. Hello, Matt. How are you doing today?
Hey, Justus. I'm doing pretty well. Thanks for giving me a call. I'm definitely excited about being part of your podcast.
Well, I'm really glad to have you on. We've been friends for a while now. When did we meet? Was it last year or the year before?
I think it's been 2 years now. It's definitely been a while. You know, time always flies. There was a planning meeting for a networking event group that was being put together in Boston, and I think we were both there that day and met up and then bumped into each other a couple more times at events at WeWork and other things around town, and just eventually became friends and started working on projects and putting our heads together and trying to figure out how to save the world.
Well, that's like my favorite topic of conversation, and maybe we'll get to saving the world today, but I want to start with networking events because you actually go to quite a few, and you and I like to go to parties and stuff together. So first of all, I want to know, like, is that still a habit for you? Are you still getting out there and kind of meeting people around the Boston scene? And, do you have any funny stories relating to that get out and about behavior that you want to share?
Yeah, there's funny stories. I'm not sure that they're always appropriate, but they're not always family friendly, but there are some funny stories.
This podcast is not fucking family friendly. So,
right.
Yeah, feel free.
Right. I still go to a lot of networking events, and what I've noticed in the last 6 months or so, certainly over the last 5 years, but even more profoundly in the last 6 months, is that the networking events seem to be subdividing into little categories, and those divisions become finer and finer. So, in the past where you might have had a Boston tech startup event, now it's become specifically ed tech or fintech or something of that nature. And, even within those groups, you're finding more and more divisions.
So do you see this as a good thing? Like, are you enjoying being able to kind of deeply explore a specific vertical when you go out, or is it not as interesting? I mean, well, first of all, maybe you could explain to the audience, like, in what capacity do you go to a networking event? What are you trying to get out of it when you go?
I think, that kind of depends. Everyone that I go to, obviously they have different topics that they're centered around. So one might be, how to raise cash without giving up equity. How to raise capital without giving up equity. Some of it might be, more specific to marketing or something else within, say, the fintech industry or the ed tech industry or something like that. So I think to answer your larger question, there's both benefits and drawbacks to having the focus of the event be extremely narrow. The advantage is clearly that you know what you're getting. It's not going to be a wide-ranging conversation about any general topic within the startup world. It's going to be very specific. And so the people who are going there are going to be, or certainly the people who are presenting there are going to be specific professionals who can talk to that narrow focus. at the same time, so that's sort of the pro. The con is that you only get people who are there for that specific reason or who have a background in that specific area. So if we're talking about an ed tech marketing event, you might not get people who are on the financial side of ed tech who are sitting in the CFO's chair or something like that. You may only get people who are coming from the marketing side, the creative side of the industry, but happen to work in ed tech. So you tend to meet a more narrow group of people while you're out there networking, which can be great. Like I said, you know exactly what you're getting, but at the same time, you're less likely to randomly bump into somebody who could totally change your world.
Yeah, I think it's really interesting because you and I obviously met at one of these networking events. It was kind of a smaller group setting, and we hit it off really quickly and became really good friends socially. And I think that when you're friends with somebody who is complementary to you, you're always looking for projects to work on together. Obviously, you are actually coming from the finance investment background. Maybe you could share a little bit about yourself in terms of, what you do, but also, have you had many experiences like that where you actually develop deep and meaningful relationships from attending these events?
Sure. So to give you a little bit about my background, I came out of a financial services background. I was working for a long time in the banking world, the commercial banking world, specifically in commercial real estate underwriting. And before that, I had been working in the financial services sector in other capacities. I have my chartered financial analyst designation from the CFA Institute. And that's something that typically financial analysts get in a more stock research, bond research environment. Tends to be people who work a lot in financial services as opposed to specifically within the real estate world. So that was my background. Coming out of there, I got a pretty good training in understanding what metrics to look for when you're investing in real estate. And so that's kind of the lens that I bring to most things that I do, is that sort of analytical lens of, is this worthwhile, and what are the prospects, financially speaking. So, going to some of these events, as you mentioned, we met at a smaller event. There were probably 10 people or less that were at that event. I think a lot of times it's easier to build that bond when you have a smaller group. When you're in a room of 50 people, chances of you getting to talk to everybody in that room in the next hour is pretty slim. If there's only 10 people in that room, obviously the odds are a lot better that you're going to get to speak with everybody and spend more time speaking to each person. So going to small events definitely has an advantage. At the same time, if the event is too small and it's not the right crowd, or it's not the group of people that you necessarily want to speak to, if they're at different stages in both their education and their startup, it may not be beneficial to you. And so therefore it could be a little bit of a drawback going to an event with such small people. It's really hard to know. Networking events are really kind of hit or miss. And sometimes you strike gold and you meet 10 people who are going to be hugely important to your project going forward. And sometimes, you go home and maybe you got a couple of free beers, but that's all you got out of the night. So it really is kind of a volume game where the more events you go to, the more likely you are to be successful in meeting people who can help you and who you in turn can help.
Yeah, I'm trying to think off the top of my head if, I've made other friends that were really valuable to me, either socially or in a professional sense. And other than you, I can only think of one person ever. And I'm a pretty outgoing guy. I'll go out and I'll talk to people. I'll strike up conversations. And it still seems like networking events, maybe it's because, we're all going in there sort of with a business mindset, that there's a lot of domain dependence. People don't think to themselves, oh, maybe I'll make friends here. And so, do you find that to be the case, or it sounds like you might have had more success than me in terms of developing long-term relationships out of events like this?
I will say that I've definitely made some long-term connections and people who were both helpful to my project in the near term or immediate term, as well as meeting some people who, weren't immediately in a position where I could help them or they could help me, but down the road, we were able to either maintain the connection over time or reconnect down the road, and we were able to help one another down the road. So I would say that I've made a handful of connections over the years that are real, true friends and who I'm friends with on a social level, like yourself.
Aww.
And say that I have made a larger number of business connections that have been beneficial to whatever project I happen to be working on.
So overall, it's something that in general you would recommend for, let's say, so maybe we do need to back up a little bit and talk a little bit about your career trajectory. You were working full time in this sort of underwriting financial position, and then you left to do investing full time. Let's just start there. Like, why did you leave? When did you leave? What enabled you to leave the full time racket?
Sure. So I left about a year and a half ago, give or take. And I think there were a number of factors that allowed me to leave my day job, let's call it, my full-time corporate job. One of those was certainly, planning for it. It wasn't, an impulsive decision. It was something that I planned on doing. And so it allowed me the time to save up a decent amount of capital so that, I could cover my living expenses, my food, my rent, etc., for at least a couple of months, knowing that anytime you start a business, you generally don't have a significant revenue stream in the first couple of months. It takes a little bit of time to get your name out there and also to develop the network that you need in order to successfully execute your project. So that was one thing, saving up capital. Another thing was certainly developing the network of contacts, and that's where the networking comes in. You can think of it as a marketing strategy. I know some people do, where you go to networking events, you give out business cards, you shake hands, you meet people, you get the name of your brand new company or project out there, and you make those connections and figure out how can people help me and how can I help them, and where is that going to go? And once you have that network of contacts, then usually if you've done your homework, if you've made the right connections, they'll help you to continue to solicit business. They'll throw business your way, you throw business their way. It's a symbiotic relationship. And that's definitely, in my mind, a huge key to setting up a new company is being able to, if it's not you, somebody in your company goes out there, networks, and gets your business name out there to the people on the ground. It's basically grassroots advertising. Another thing was that I spent the time to acquire the skill set that I would need for my new company while I was working my full-time corporate job with my old company. And, for me, in my position, that skill set was the ability to analyze a real estate property, determine its value, determine what the value would be after construction or renovation or whatever, and how much profit there was in it, what all of the costs that go into it would be, because there's a lot more than is sort of immediately apparent. In addition to purchasing the property, which obviously costs money, and doing the construction, you have to pay for the money that you borrowed, whether that's from a bank or a private source, and we can talk a little bit about those later. Whether that's taxes while you own a property, you have to pay the property taxes on it. The electric bills while the contractors are doing renovations, they're going to be using the electricity in the property to run their tools and everything. So there's a lot of little things that go into it. And so figuring out all of those, being able to reliably estimate what that was going to be is a valuable skill set if you're a real estate investor. If you're setting up another kind of company, your skill set might be entirely different.
So you're working full time, you're developing the skills necessary to vet a potential real estate investment and kind of navigate the financial process, et cetera, and the budgeting, et cetera. You're much more good at this sort of quantifiable financial aspects of business than I am. That's why I think we get along and have a great complementary skill set. I'm curious, and you're kind of de-risking the proposition of going into business on your own by saving up capital in terms of having a reserve to get your life, style funded. I'm curious, when you made the jump, if you can give me specifics, like, okay, I had 3 months of cash in the bank for my life, and I had $200,000 in startup capital. What was the specific situation when you decided to leave your full-time gig?
Yeah, that's pretty close to the right numbers. I had about 3.5 to 4 months of living expenses saved up. And part of my networking was talking to investors who were willing to invest with me when I found properties. So, I had about 400,000 in investors who had committed to me either verbally or on paper that they were going to invest with me going forward.
You did? Okay.
And that's one of the keys to, at least real estate investing, is that while you use some of your own capital to purchase properties, it tends to be larger investments from outside investors.
So what kind of person do you think does really well at this kind of business? You're still in the early part of your career, but there must be people that you look up to and whose qualities you kind of are trying to emulate.
Sure. I think there's a couple of things that I would tell you. People who tend to be have more of a long-term perspective, I see doing better in real estate because it's a cyclical industry. And so rather than getting extremely aggressive and then, having a lot of trouble when the cycle turns and then getting extremely aggressive again, it's almost a tortoise or a hare kind of thing. So the people who are the tortoises seem to do well. Obviously, you need to be able to recognize an opportunity when you see it, and you need to be able to be comfortable with risk. And I think that's probably true of any entrepreneur, not just in the real estate world. But it takes a certain amount of fortitude, a certain stomach for risk in order to be able to step out on your own, regardless of what industry you're in. So I think those two things are probably, in my mind, extremely important qualities.
So having a long-term outlook, having some kind of comfort around the risks. We can talk a little bit more about risk later in the show. Maybe I think one thing that I see with a lot of successful entrepreneurs is, they're called risk takers on the outside, and usually when you talk to them, they were so confident in themselves that they didn't see it as much of a risk, or maybe they refer to it as a risk, but they clearly, if they thought it was really that risky, they've always, I'm sure that even you, and actually that's a good question. Did you have some kind of safety net? Did you have a backup plan if you failed?
I did have a backup plan. I put in enough time, banked, and been a good enough employee to where I could go back into the banking world if I needed to. And there's really nothing wrong in that world with taking a couple years off to go start your own company. If the company's successful, fantastic. You do that the rest of your life. If not, you go back to your old job. There's plenty of people I know who have done it. And so I think that's certainly one safety net. another safety net is you can always go work for a small investment firm, small real estate investment company for a couple of years rather than going back into banking, and then try to strike out on your own again.
I'm
So those are
curious.
the
Yeah,
backup plans.
so you definitely did have some kind of backup plan. I think most people who get into business have a backup plan, and I think that is a huge way that we de-risk the propositions that we get into. I'm curious, if you could go back in time a year and a half, what would you do differently getting into business for the first time for yourself?
I think despite what I just said, I would actually have been a little more aggressive. I think I was a little conservative. One of the things that I definitely did right was setting up my current business while I was still working in my corporate banking job, because that allowed me to buy my first property only a couple of days before I left my banking job. And so by starting the company and, tiptoeing into it while still having full-time salary and health benefits and everything else, really kind of helped ease the transition and de-risk the proposition. But if I could go back, I probably would have bought, 2 or 3 properties early on, because as you can see, the real estate market has continued to rise since mid to late 2015 when I left my job. And if I had had a couple more properties, would have been doing even better than I am.
So this gets me to my next question, and I think we talked a little bit about this before the show, which is economic cycles. Obviously, the real estate industry is extremely impacted by macroeconomic conditions. It's now been 9 years since the Great Recession of 2008 began. What are you doing to mitigate the risk of a catastrophic macroeconomic downturn?
Well, there's some things that you can do, and there's some things that you just simply can't do. They're beyond your control. So what I am doing is I'm looking at properties in primary markets as opposed to secondary or tertiary markets. Primary markets are going to be the ones, generally speaking, in major metro areas, Boston, Cambridge, and Somerville. To a certain extent, Brookline in the Boston area are going to be your primary markets. They're much more insulated against a downturn. Generally in real estate, a real estate downturn, generally speaking, tends to happen when the economy fails. People can't afford to buy houses, and people are going to want to live closer into the city. So I'm buying properties that are closer into the city, whether that's Boston or New York or Los Angeles, whatever. That's something that you can control. The stuff that you can't control, I will say that I think a lot of Boston's real estate market appreciation in the last, call it 5 or 6 years, has been fueled by outside capital, by foreign capital. And I think a lot of that money is coming out of China, a lot of it's coming out of Russia, and those parts of the world where your money isn't necessarily quite as safe as it is here in the United States. Your property is safe here in the United States. The government's not going to take it away from you. So a lot of that foreign capital has been coming in, and if those countries really, truly shut off the tap, there's not a whole lot we can do. That foreign capital will stop flowing into the United States and into the Boston area, and that's going to really hurt prices. I think, obviously, anytime you have a presidential transition from one president to another, there's always new policies, new tax laws, new economic policies, and those have a certain amount of extent. Especially the domestic policies have an impact on your real estate cycles, have an impact on the economy, and especially if those domestic policies upset international trading partners and foreign capital is a factor, then it might exacerbate the problem. So there's some things that you can control, and there's some things that you cannot control for the cycle.
Now, the other line of business that you invest in is startups to some extent. And I know that it's definitely a minority of your portfolio, but you've also seen some success in startup investing. I am a big fan of Nassim Nicholas Taleb's idea of dumbbell strategies, where a small percentage of your assets go in high risk investments and a large percentage go in very low risk investments. And I kind of see that as being what you do to some extent. Real estate seems like a pretty safe investment, at least to a lot of people, and startups seem like a highly speculative, highly risky investment to a lot of people. Do you see it that way? And what is your current status with startup investing? How do you see that market unfolding?
It is, to a large extent, a dumbbell strategy. I see it as downside protection. Real estate is something that you ideally want to buy, just like stocks, when the price is cheap. Buy low, sell high. That's been the adage since the beginning of time, since investing started. I think when real estate is doing poorly is generally when the economy is doing poorly. So you want to buy real estate in a down market. For example, if any of us bought real estate in 2010, just after the downturn, and held on to it till now, you'd be doing great. That property will have appreciated no matter where it was in the country that you purchased. And if you bought it in the right places, it will have appreciated several times over. Startups, it's harder to get financing for a startup in a down economy. After the bubble burst in 2001, in 2009, it's a little bit harder for startups to thrive in those kind of environments. Real estate is something you want to buy when the economy is not doing well. Startups tend to do better when the economy is doing well, and prices of real estate are going to be high when the economy is doing well. You don't want to buy into real estate at that point. So on some level, they seem to be good counterbalances to one another, good investment opportunities at different times within the economic cycle. I think that we're probably going to have some sort of pullback in the near future. So I'm not investing quite as aggressively as I was, a year ago or so in startups. I think, as you said, I have had some success in my startup investing, and hopefully that continues. The startups that I'm already invested in, hopefully they continue to increase in value going forward. But I think a lot of people who I've talked to, both in the startup world and in the real estate world, are largely in a wait-and-see mentality right now. And of course, if an awesome deal comes along, you're going to chase an awesome deal. I mean, no reason not to. But it's got to be really special right now because there's a lot of uncertainty.
Yeah, and Boston is a particularly difficult market for early-stage startups looking for investment. At least when you compare it to somewhere like Silicon Valley, where if you've got a great team, you can probably find an investment even without an idea. I'm wondering if, and this is really just me talking out loud at this point, but I'm wondering if Boston, if the economic climate there will ever be conducive to super early stage investing a la Silicon Valley.
I think that Boston has a long history of being a somewhat conservative culture. And I'm not just talking about startup investments, but in general, by and large, Boston tends to be a little bit conservative socially, and I think that on some level does hold back some of that early stage startups from getting investments. I think people want to be sure, or at least a little bit more sure, before they spend their money, or in the case of an asset manager, their client's money. I read something the other day that was an article that compared Silicon Valley to Boston, and why, especially since the late 80s, early 90s, why Silicon Valley has flourished so much more than Boston, specific to the startup scene. And one of the things that they mentioned was that California doesn't tend to enforce clauses in your contract that say that you can't, take an idea from a company that you used to work at and go start up your own company. They won't enforce those, the term is escaping me, but in your employment contract, a lot of times it says you can't go work for a competitor for at least a year or something like that. So because Massachusetts and most other states enforce those, it limits the mobility of people to go and start their own startups. If they were previously working for one company, they can't then switch companies or open their own company based on the same or reasonably similar idea. And the article was saying that that's really held back other areas, and that's been a main reason why Silicon Valley has flourished, because people can just, if they're great entrepreneurs or they're great at one specific thing within their company, they can't just jump ship and start their own company the way a lot of Google execs have been leaving their self-driving division and starting all of these new self-driving car companies and stuff. So that may have something to do with it, but Boston's definitely a little bit more conservative.
Yeah, culturally, I would certainly agree with you. So I want to return to real estate investing for a minute because I want to go through a thought experiment for my own benefit. Let's say that I want to get into real estate investing and I am really debt averse, right? I do not want to borrow money from anybody. I'm willing to partner with investors, but I don't want to get mortgages from a bank, let's say. Let's talk about this hypothetical scenario. If you were going to mentor me and give me kind of a curriculum for real estate investing with those constraints, what kind of startup capital would you suggest I have? How many investments would you suggest making up front? Are there any markets you think are particularly undervalued that you think might be wise to get into? Would you say wait until this next recession hits and then buy? What would be kind of your curriculum for me or your program for me to get started?
Well,
assuming that I can have any amount of money, right? So you can just say we'll have this much money. Like you need at least this much money to get started with those constraints.
Sure. Yeah. I think first thing I'll tell you is that I think it's challenging to do real estate investing if you're debt averse. The way that you make money in real estate, as with most companies, you have equity and debt that make up your capital stack, and the less equity you have to give to other people, the more you can keep for yourself. Therefore, the more you can make when you sell a property. Same as any other industry. So it's definitely in your own best interest to put as much debt on the property as you can and give away as little equity so that you can keep more of the profit for yourself. But if we're working in a debt-averse scenario, I would tell you that you could reasonably start with as little as $150,000 to $200,000. You can buy, whether it's a single-family home or perhaps two-family, in some of the outer suburbs, even in Everett or Chelsea, which aren't really outer suburbs of Boston, but certainly in Melrose or places along the North Shore, South Shore, Weymouth, Brockton, places like that, where you can get a two-family for 150 to 200 grand, and you might have to spend another $50,000 or $60,000 to give it a facelift, and that's all you need, and then you can start renting it out. Once you have that property rented, you can move on to your next one if you decide to keep it and rent it rather than flipping it. So it really doesn't take all that much. Now, I'll tell you, for the price of some of the two families in Boston, say you buy a two family for $500,000 in Dorchester or something like that. For that price, for $500,000, if you take your money and move it to another city, say San Antonio, Texas, you could probably buy 5 two families for 500,000. A two-family in another city might go for $100,000. So some of what you need in startup capital depends on where you want to invest your money. If you want to be in Boston or New York, it's going to be more expensive than if you want to be in Atlanta or another city down south, which tend to be a little bit less expensive.
There seems to be some sort of element to it where the market really determines the risk amount as well. Like I can see a world where if you invest any amount of money into the Boston market, like given a long enough time frame, you're almost guaranteed to make money. And the same would go for New York. And then I could also imagine that if you were to invest in a house in, let's say, Baltimore or Detroit, you're basically spinning, like playing roulette. Like you might see a return over 10 years, or they might just continue to get shat on. Would you agree with that?
Yeah, I think that's 100% correct. Boston and New York tend to be markets that have experienced stable growth. Certainly there have been periods of pullback like 2009, which impacted the entire country nationwide. But even in the worst crisis in our generation, 2009, the downtown Boston market, I'm talking about Back Bay and Beacon Hill and South End, certain parts of Cambridge, certain parts of Somerville to a lesser extent, maybe a couple of areas of Brookline, didn't experience any drop in prices. They certainly had zero growth for several years, but they didn't see negative growth. Now, you go further out into the suburbs, Newton, Wellesley, Brockton, Braintree, Quincy, those areas did feel some pullback. And the further you go outside of Boston, the more pullback there was. And that's true of every city in the country. The further outside of the city you go, the more pullback there was. But to answer your question, yeah, I think there are certainly cities where it's entirely unclear where they're going to be in 10 years. With somewhere like Boston or New York, you know that at the very least you're not going to lose your money. You will certainly make some money. Now, if you invested in Detroit today, just like if you invested in the stock market, there are certain stocks that you can buy where you might double your money in a year to 2 years, or you might lose half your money in a year to 2 years. And Detroit and Baltimore are cities like that where you're taking more risk. And there's an expression, you get paid for the risk that you take. So you're taking more risk in Baltimore and Detroit. You have a greater chance of increasing your money by a larger amount than you do in Boston or New York. But at the same time, Boston and New York are safer bets.
Yeah. I could see myself betting on Baltimore. I couldn't see myself betting on Detroit. I'm probably going to get hate mail for that.
Goes back to risk tolerance. You got to have a certain amount of risk tolerance. Everybody's got their own, and there's nothing wrong with having more risk tolerance than somebody else or less than somebody else.
Yeah, I can just think of a laundry list of reasons why Baltimore is going to be a better bet, and I can't think of a laundry list for Detroit other than it's in such a bad situation right now that there's only one way to go but up. I think that's the kind of rationale that leads you to making bad decisions. Let me continue down this path of so now I've got a number. I've got about $250K in the bank because I don't want to take on any kind of debt. Maybe I've got a partner who's doing this with me, so we can kind of finance a couple of these places at a time. So I buy a place kind of in a secondary market, and I've got for 200K or 180 or something, and now I'm going to spruce the place up a little bit, do some renovation, make sure it's ready for a sale. Let's assume I don't want to rent because I don't want to deal with tenants and being responsible for the property in a long-term sense. Now, what does that process, like when you're starting to look at a house in terms of, I need to improve this house, like where do you start?
Well, in real estate investing, you generally look at everything on a per square foot basis. And what that is you want to be able to compare apples to apples between properties, whether they're on the same street or 6 streets over or 2 towns over. And the easiest way to look at that is the cost that you're going to pay for each square foot of real estate that you're buying. Obviously, you make adjustments. Certain towns are worth more per square foot than other towns, and that's just the way it goes. So the first thing I'm going to look at is what's the seller asking per square foot. So if they're asking for $1,000 and there's 10 square feet, then your per square foot is $100 per square foot. That's the cost that you're going to pay.
Right.
Just using simple numbers just to keep it easy. So now I know what my cost is to purchase it. And of course, there's other things that go into it, not just the seller's price, but there's your attorney fees and any other fees. You might want to get an appraisal or a home inspector or something like that. When you're doing investment real estate, you tend not to use home inspectors just because you're planning to rip the place apart and make renovations and make improvements anyway. But it never hurts to have a home inspector go through there. So now you know what your price is going into it, your purchase cost plus the associated fees and expenses. And then you're going to look at what have other properties that are reasonably similar to my property that I'm trying to buy going to cost right now. What's recently sold, on the street that I'm on. Maybe sometimes you do within a half-mile radius. Sometimes you're going to do within a 2-mile radius, especially if you're in a secondary market. There might be fewer physical buildings within a small radius. Houses or commercial properties or whatever you're looking at might be more spread out. So you might have to expand that radius of what you're looking at. And you probably want to look to see what's sold in the last 6 months and what prices that's sold at. And so that's, generally speaking, what you want to assume your upper limit is going to be is what things around your property have sold for in the last 6 months.
And I guess doing that, you do that research before you buy too, and that gives you an idea of when you're getting a deal, right?
Right.
Okay.
And so what those two numbers tell you, what's recently sold and what you're buying in at, tells you how much you have in the middle between those two numbers to make your profit. And of course, you're going to have your renovation costs and your costs to sell, such as attorney's fees and the amount that you're going to pay the broker to sell the property for you and things like that. And so,
generally speaking, what kind of percentage of total costs do those add up to?
Generally, the broker takes 5%.
Holy cow!
2.5%. Yeah, they take 5% of the sales price, and they keep 2.5% themselves, and they give 2.5% to the buyer's agent, whoever buys the property from you. So you're losing 5% off the top, right there. A lot of people I know will calculate their returns, before the broker takes their commission. Some people calculate it after. It's really kind of dependent on how you want to look at your revenue stream.
So I want to break this down by steps. So it seems like before I buy the place, I'm going to do a bunch of research in the markets that I'm looking at, get an idea of what the average cost per square foot is, get an idea for the top cost per square foot, and then my purchase is going to be a place that's near the bottom per square foot cost, right?
Yeah.
Okay, and then I've bought the place. I've got to factor in, as a part of my costs, the broker and the legal fees, etc. I've bought the place. Now I'm going to flip it. What percentage of the cost, is there some kind of expectation that you have around how much money that you can budget on a renovation in per square foot? Is it?
Yep.
How does that work?
Yep.
How do you?
That's exactly right.
Okay.
Everything's on a per square foot basis. So let's say I'm buying a property at $100 a square foot, and the property next door sold for $500 a square foot yesterday. So now I know that I have $400 per square foot to make my profit. Generally, in the Boston market, you're seeing construction costs anywhere from $150 per square foot to $170 per square foot. It depends on how
to build a house from scratch.
You're probably looking at $175 maybe $195 a square foot to build from scratch, including putting in the foundation and running the sewer line from the street into the house and everything else. It gets more expensive. If you're simply renovating an existing structure, you might be able to get it closer to $150 a square foot. But so if we buy at 100, and let's say we renovate at $150 a square foot, so now we're into it for $250, and the house next door sold for $500 a square foot, assuming both our property and the one next door are the same size and the same quality. They look nice. We've used the same or reasonably similar type of marble in the bathroom and, granite in the kitchen and all those kinds of things. So then you can assume that you have $250 a square foot in costs as well as $250 a square foot in profit in that property. So you're going to make a 50% profit. Now, of course, that's before you include all the attorney's fees and the accountants and the cost to set up an LLC to hold the property while you're doing the construction and all of the little nits and gnats that go into it.
And there seems to be, renovating a house is a pretty complicated thing, right? There are a million little considerations. Do you have one organization that you kind of rely on to design and execute the renovation? Do you have like several subcontractors that you're managing? Because it appears, in my head, I would imagine that if you kind of manage everything yourself, you can bring down that per square foot cost of the renovation significantly.
To an extent.
But it might not be worth your time either.
Yeah, that's what I was going to say is it's a better use of my time to hire a good contractor and, of course, check in on him periodically without micromanaging what he's doing, and allow him to manage the construction while I go and look for other properties to acquire. It's a better use of my time to acquire properties and put together investors and set up more deals than it is to sit there and watch the contractors come in and out all day long.
Okay.
But to answer the other half of that question, usually what you want to develop is a roster of either contractors or subcontractors, architects, anybody who's part of your team. Because until you get to be a really significant sized company, your contractors are going to be working with you, but also with other people. So you generally have your A team, your B team, and your C team. And if you're doing a really high-end renovation, you really want your A team. If you're doing a renovation in a secondary market where you're not going to be able to get absolute top dollar when you go to sell the property, maybe you use the B team contractor and subcontractors, and they're going to cost a little bit less. They're not going to do quite as nice a job, but in that market, what's expected in that market isn't quite as nice as what the A team, can put together, and so you just don't, frankly, need them.
Right. So you do the research to pick the place, and that's kind of the bulk of your work. Once you pick the place, you coordinate with your teams to renovate the place. Again, you're measuring everything in cost per square foot, so the purchase price and cost per square foot, then the renovation price and cost per square foot. Your profit, you're probably measuring in cost per square foot. Then you go to do the sale. Do you have like a point person or point realtor that you go to say, hey, list my place for me and just get it sold? How does it work? Do you take knowing that I've never bought or sold a house in my life, by the way.
Right. So that's definitely an area where I feel like it is worth my time to spend the time doing that within reason. If a property is an hour away from where my office is, it's probably not worth it for me to handle the showings myself and be the listing agent for that property because I'm going to have to go an hour out of my way every time somebody wants to see the property. So if that's the case, I would definitely hire an agent who's local in that market, knows that market really well, and can bring in a lot of buyers to see the property or potential buyers. If the property is close to me, though, I would definitely serve as a listing agent, and it's worth it to me to save the 2.5% commission by showing the place and being the listing agent on file. Of course, I'm still going to have to give the other 2.5% to the buyer's real estate agent.
Right, and I want to point out that this problem that you're solving by being your own listing agent is detailed in. It's not just the 2.5% that you lose to the real estate agent. It's also that agent has less of an incentive to negotiate your price higher because the nature of the mathematics here, where if they are only making 2.5%, they're only making a little bit more money for negotiating that price up. But that's a negotiation that you want to have. Is that right?
Yeah, that's fair. I definitely want to, keep the price as high as possible, and obviously, the more I can keep the price up, the larger that 2.5% slice is that I'm going to give to the buyer's broker. So they, on some level, have an incentive to keep the property price up too. But the higher it is, the more I'm saving by keeping that 2.5% in my pocket, rather than giving the whole 5% away to an independent listing agent.
Right. So I had a question here where I'm curious. I've done the research, I've done the renovation, now I'm selling the place. Do you have like a particular point in this business process that you're executing on a day-to-day basis that is the highest friction point, like the most difficult, like where's the most challenging aspect of all this for you to deal with?
I think there's a lot of different challenging aspects, and there certainly isn't just one. One of the things that can be very frustrating, and an experience that I had recently, is when you get to a certain point in the construction and the inspector comes in to take a look, and you're ready for that inspector, you feel like you've prepared for that inspector, and they come in and they take a look and they say, well, I don't like this, this, and this. And then you have your contractor fix it, and the inspector refuses to come back. And you find out 3 weeks later that the contractor and the inspector have some personal history, have some personal bad blood between them, none of which you knew about before you hired the contractor or started work in that town where that inspector works. And the guy just refuses to show up to your property for 3 weeks, which pushes you back 3 weeks in terms of when you can get the property on the market. And in a world where you are using debt financing, you're obviously paying interest rates for an additional 3 weeks. And so that can be very challenging.
So wait, inspectors have some kind of beef occasionally with a particular contractor? Like, why would that dissonance even occur?
In this situation, they happen to know each other outside of work, and they didn't like each other. They didn't get along. And so there was nothing that my contractor had done specifically wrong on the job. But, the inspector has the right to show up when it fits his schedule. And if he can somehow claim that he's so busy inspecting all the other properties in the town that he doesn't have time to get to you for 3 weeks, that's politics on some level.
So this is fascinating to me because I know, at least in my hometown, that's, a pretty booming suburban town. The real estate developers really have a lot of political pull. And I'm wondering, how does it work? How does the inspector market work? Who's hiring the inspector? Is it a free market? Is it somebody who's owned by the government? How does it work in your market?
Well, I don't know too much specifically about what the hiring and firing criteria are for, say, an electrical inspector or a plumbing inspector. But I will tell you that they're generally speaking city or municipal employees. So they're hired by the city or the county, as the case might be in some of the secondary and tertiary markets. And, that's one of the reasons why a lot of real estate developers are politically active, because, if they're friends with the mayor, then the mayor will, perhaps help them get a permit or help them, get the permit approved at the end when the inspector comes in to do the inspection. to close out the permit. So there are definitely advantages to being politically active. I'm personally not politically active. I've never been a huge political wonk. It's not really my thing. And my company is small enough at this point that I don't need to be, because I'm below the radar, and it would only force me to compete with those larger developers for political favors, and I have no interest in going down that road.
Right.
At some point down the road, when my company is hopefully significantly larger, it may make sense to explore that possibility, but I'd rather do it the right way than try to ask for favors and stuff like that. It's just, once you go down that road, it's just messy and it's not good.
Right. So this inspector problem that you had recently was more of a one-time thing. It doesn't happen all the time. Do you have more chronic issues that you're dealing with? And the reason I ask is I think that problems, I'm an engineer, right? So if I hear about problems, it gets me thinking, okay, well, what are solutions, right? And so it's really just a way of exercising my idea machine. What are some chronic issues that you've dealt with that you're like, damn, I just wish that I didn't have to deal with this part of the business?
Well, I'll tell you, I've been lucky enough to avoid problems in terms of contractors creating more problems for you. One of the things that you have to do really well as a real estate developer or investor is to hire well. Mm-hmm. And you have to hire the right people. And if you don't, there are a lot of different ways that things can go badly.
Do you see that as being one of your core competencies, is hiring the right people?
Yeah. I think the ability to talk to people and network with people definitely translates well into the ability to hire people, just to speak with them, have a conversation, get to know them a little bit, figure out what they're all about. And then obviously hire them if they're the right people.
So it's funny because I consider you one of the most naturally likable people that I know. I don't know anyone that I've introduced you to that didn't immediately, find you to be maybe affable is the right word. And I'm wondering if, your success in that part of the business, is it something that you're doing intentionally? Do you see it as just being something that comes native to you? Do you think that the contractors you hire would do, is it 80% the fact that you hired the right guy, or is it 80% the fact that you hired a guy and gave him a really good reason to do good work for you?
Certainly incentivizing people correctly is a big part of the equation. And I think that's kind of what you're touching on. Properly incentivizing them is huge. If you can say to a guy, look, if you finish this job on budget and on time, I'll give you a bonus. Because in the financial services world, bonuses are, very common. It's pretty uncommon not to get one. In the construction world, you don't necessarily get bonuses. You don't expect to get a bonus when you're done with a job. So if you can offer a guy, even something as small as a 5% bonus or a 10% bonus, if he finishes on time and on budget, that's huge. At the same time, you probably also want to say, listen, if you're more than 3 weeks late, or if you go more than 10% over budget, then there's going to be some sort of penalty involved. Maybe if you're 10% over budget, there might be a 5% penalty. So where he's essentially splitting the cost of the overage with you.
So there is a whole sort of incentive game that you play with the people that you work with. And part of it are explicit incentives that you make, like you said, a bonus if you complete on time, or penalties if you don't. And then I think what you probably do natively that maybe you don't even notice is this idea of just being someone that they love and want to do a really good job for.
Sure, of course. And, I think especially when a contractor is working for a developer, there's an unspoken understanding, and sometimes it is written down or spoken, that if the contractor does a good job, you're going to bring them back for future jobs, and you're going to, use them on your next project or your next 3 projects or whatever. When a contractor is working for a homeowner, they don't necessarily have that incentive. If you bring somebody in to, paint the walls or to redo your kitchen or something like that, and you're a homeowner and you don't work in the real estate industry, they're going to look at that as a one-time job and just sort of say, okay, well, I need to make a certain profit margin off of this. Whereas if you're a developer like I am, they're really looking for repeat business, and they're sometimes willing to go the extra mile.
I love it. That's a whole psychological dimension to the business that you're in that I had never, ever thought about before. So that's really fascinating for me. So, Matt, we're coming up on an hour here, and I want to be respectful of your time. Is there anything that you want to talk about, anything that you want my audience to think about, as they go about their day? And, if you want to be found, where can they find you?
Sure. I think one of the things that is just really important in investing in general, whether it's real estate or startups or stocks and bonds or anything like that, is just to really do your homework and know what you're getting into, and build in a cushion to where, if the investment drops by, say, 10%, are you okay with that? If the investment drops by 50%, do you have enough to get by? And, is that going to seriously impact your day-to-day life? There's always going to be something, whether it's real estate or other investing, that you're not expecting. There's always going to be that unknown risk that you're taking, even though you don't realize you're taking. So just be prepared for that potential downside. And one of the reasons why you look for investments with such potentially large upside is that upside acts as somewhat of a cushion. If you're expecting a 50% rise in the value of a property and it doesn't quite get there and only goes up 20%, well, then that 30% cushion, that's your cushion. So, it definitely helps. If the property only goes up 20% instead of the 50 you were expecting, can you still meet your payroll, and can you still, keep everything running? So that's just something I would say: do your homework and know what you're getting into, but also have a cushion, because there's always something that you're not expecting. My company is Axelon Capital Partners, AXILON, and our website is axeloncapital.com. Our phone number is 973-788-9333. I'm always happy to talk to people who are thinking about getting involved in real estate investing or startup investing. I'm happy to mentor people who are looking for a mentor. And, if somebody wants to talk about investing in one of my projects, I'd be open to talking to them about that as well.
Awesome. Matt Javitch, everybody. Thank you so much for your time.
Thanks, Justus.
Well, that was a good episode, if I do say so myself. Thanks so much to my good friend Matt for coming on the show and teaching us about real estate investing. It was really enlightening for me. If you enjoyed the episode, then you should go on iTunes and subscribe to the show. It's called Hacker Practice. You should also leave us a review on iTunes, because if you leave us a review on iTunes, then more people will see the show. Finally, if you didn't like the show or you just want to get in touch, you should go to hackerpractice.com and fill out the feedback form on that page. And that is all of the outro that I have for you today. Hope you enjoyed the episode with Matt Javitch. See you next time.